introduction, financial institutions are one of the most significant components of any country's financial system. They are essential in determining the efficacy and efficiency of the financial system. Nevertheless, there are intervening forces that affect economic stability and company growth. Non-performing loans are one of the variables affecting bank stability and growth. In general, non-performing loans are loans on which the borrower is not making interest payment or paying any principal. There are several factors that lead to non-performing loans. With continuing credit growth and financial system development, nominal statistics for NPLs climbed dramatically in several East Asia and the Pacific countries in the years preceding the outbreak of COVID-19. According to the World Bank, China accounted for more than 85% of total NPLs at the end of 2019. Cambodia and China have had the biggest percentage rise in nominal quantities between 2010 and 2019. Only Malaysia looks to be in a better situation in these terms than it was 10 years ago, with a 31% fall in the nominal amount of NPLs from 2010 to 2019. This is due to several factors that occur.
In early 2019, non-performing loan in Malaysia has decreased compared to the past 10 years. By referring to the World Bank, Malaysia is the only country that looks to be doing better in terms of non-performing loan, compared to the 10 years ago with a nominal number of NPL falling by 31%. Furthermore, non-performing loan decrease led to an increase in Malaysia banking sector's profitability in 2017. According to BNM, due to a decline in non-performing loan, the banking sector's profitability increased by 12.3% year-on-year to RM36 billion in 2017. Hence, if the issue of non-performing loan continue to decline, the economy will be in a healthy condition. Thus, this study is to determine the relationship between the interest rate, inflation rate and gross domestic product on non-performing loan in Malaysia.
Next, its research objective. Firstly, to examine the factors that influence non-performing loans. Secondly, to investigate the most significant factors that influence non-performing loans. Next is research questions. Firstly, are there any factors that influence non-performing loans? Secondly, what are the factors that influence non-performing loans?
Now, let's move on to the variable description under research methodology. The dependent variable that we use in this study is non-performing loan, NPL. The term non-performing loan refers to a loan that has been impaired when a borrower's loan has been unpaid for longer than 3 months. Next, the independent variables that have been used are first, inflation rate, INF. It can be defined as an increase in the consumer price index, which is a weighted average of price for a variety of goods and services. Second is interest rate, INT. It is applied by the bank to the total amount of overdue loans. Lastly is gross domestic product, GDP. GDP is a standard measure of the value added made in a country during a certain period through the production of goods and services. The data for NPL and GDP was taken from Bank Negara Malaysia, while for INF and INT data was taken from International Financial Statistics.
Next is function and equation model. For the function model, it explains the relationship between the dependent variable, which is the non-performing loan, and also the independent variable, which is the inflation rate, interest rate, and gross domestic product. While for equation model, it shows the expected sign for inflation rate and interest rate are positive relationship, while GDP is a negative relationship with non-performing loan.
The conceptual framework development provides a better understanding and clear picture on what we are trying to deliver in our study. This is to examine the significant relationship between independent variable IV and dependent variable DV as shown here. Now, let's take a look at the hypothesis statement. Based on the past study for INF and INT, the H0 is insignificant relationship with non-performing loan, and the alternate hypothesis H1 is significant relationship with NPL. While for the GDP, the H0 is significant relationship with NPL, and the alternate hypothesis is insignificant relationship between GDP and non-performing loan.
Next is data collection. Secondary data is the main source for this study. This research has been conducted in Malaysia from year 2000 to 2020 on quarterly basis with a total number of 84 observations. The data was taken from the Bank Negara and International Financial Statistics. Next, e-views was used to analyze the data.
Now, let's proceed to the method of analysis that have been used in this study. Multiple regression is an analytic technique that evaluates the relationship between dependent and independent variables. Regression result can be evaluated through 4 components, which are first, coefficient of determination, R-square. R-square is a statistical measure that assesses how variation in one variable may be explained by changes in a second variable. Second is t-statistic. T-stat is an inferential statistic that can be used to determine if the dependent variable and each independent variable have a significant relationship. Third is F statistic. F stat is used to test the hypothesis that the variation in the independent variable explains a significant portion in the dependent variable. Lastly is Dubin-Watson. Dubin-Watson is a test for autocorrelation problem in regression analysis.
Now, let's move on to the data analysis and interpretation. This table shows the summary of descriptive statistics that consists of mean, maximum, minimum, standard deviation, skewness, and kurtosis value. The result indicates the factors influencing non-performing loan in Malaysia in the time period of 21 years on a quarterly basis. The result shows that the mean value for MPL, INF, INT, and GDP are higher than its standard deviation. The mean and standard deviation value are not in the spread of 3, which means the data are low variability. Next, skewness value of MPL, INF, INT, and GDP are RM 0.4171, 0.0533%, 0.5029%, and RM 0.2607 respectively. It shows a positive value of the data distribution, resulting the skewness to be skewed to the right, and the data is almost normal because it is near to zero. Furthermore, kurtosis value of MPL, INF, INT, and GDP are RM 1.5838, 1.6404%, 2.3168%, and RM 1.7714. All of the kurtosis value are lower than 3, means the distribution are flattening.
Next is PC correlation. Based on the table, there is positive correlation between NPL and INT, which is 0.8219. It indicates that as the value of one variable increase, the value of the other increase as well. However, the correlation between NPL and INF is negative with the value of 0.8392. Same goes to the correlation between NPL and GDP is also negative, which is 0.8171. It indicates that as one variable's value increase, the value of the other variable decrease. Furthermore, for an independent variable of INF, it has correlated positively with the GDP with the value of 0.9910 and correlated negatively with the INF with the value of 0.8787. Next, for an independent variable of INT, it has negative correlation between both INF and GDP with the value of 0.8787 and 0.8508 respectively. Lastly, for an independent variable of GDP, it has correlated positively with the INF with the value of 0.9910 and correlated negatively with the INT with the value of 0.8508. Therefore, the multicollinearity problem exists because the number of correlation is high, which is above than 0.8.
Now, let's move to model regression. The table shows the equation model for dependent variable and independent variable. The result shows the constant is equal to RM 75,544 and 36 cents. Firstly, the coefficient for INF shows a negative relationship with NPL, where it will be decreased by RM 692 and 57 cents for every 1% increase in INF, indicating that when inflation is low, people can perform their loan obligations because such repayments is reduced as general inflation rises. Besides, the coefficient value for INT at RM 3,273 and 61 cents shows a positive relationship with NPL. This means that as the INT increases, the NPL will also increase, where it can be influenced by rising debt servicing costs between borrowers and variable rate contracts. Lastly, a 1% increase in GDP results in a RM 0.0446 increase in NPL. The GDP coefficient indicated a positive relationship with NPL, but past studies discovered that GDP negatively influenced NPL. However, the reason that GDP has a positive relationship with NPL is because borrowers are more likely to keep their money instead of making repayment when the economy is in a depressed state. Thus, the percentage of NPL will rise alongside GDP growth. Next is R-square. The R-square is used to assess the fit of the model. From the result, R-square of this study is 0.7387. That means 73.87% of the variation or changes in NPL can be explained by all the independent variables, and only 26.13% cannot be explained by other variables. Thus, it showed that the value of R-square is higher than 50% and is close to 1, which is good for determining how well the regression line fits with the data. Let's move on to t-statistic. The rule of thumb is 2. There is 3 significance levels, which is 1%, 5%, and 10%. Based on the table, I and F is statistically significant because the probability 0.0509 is less than 10%, even though the T statistics value are below than 2, which is negative 1.9818. It is similar to INT, which is significant because the probability 0.0100 is at the level of significance 1%, and the T statistics value are greater than the rule of thumb 2, which is 2.6373. However, GDP is insignificant because the probability 0.3329 is higher than the level of significance 10%, and T statistic value is below 2, which is 0.9741. From this study, INF and INT has given a highly significant impact towards NPL. GDP does not give a significant impact to NPL due to T statistic being lower than T critical. Next is F statistic. The F statistics in this study are greater than F critical, which is 75.3809, which is greater than 4, and the probability is lower than 0.01. It indicates that all independent variables are statistically significant in influencing the NPL. And lastly, Durbin-Watson. The result from this study is that Durbin-Watson is 0.1215, and it is not between the rule of thumb of 1.8 to 2.2, meaning there is a slight autocorrelation problem, which is a normal problem in time series.
Next is result analysis. Based on the result ordinary least square, INF is found to be significantly negative relationship in affecting the NPL. The higher INF will decrease the NPL, means that during inflation, the real worth of debt become lower and monthly repayment become easier. Thus, the H0 is being rejected, whereby there is significant relationship between INF and NPL. Moreover, INT is revealed to be a significantly positive relationship in affecting the NPL. The result is consistent with the past researcher. When a bank raises its true financing cost, it causes the interest rate to increase as well and reduce the borrower ability to repay their debt and lead to increase in NPL. From this result, H0 is rejected because there is significant relationship between INT and NPL. Lastly, GDP appeared to be insignificant factors in affecting the NPL. Result obtained is contrast with the past researchers that suggest the negative relationship between them. Unfortunately, the influence of GDP on NPL is not clear-cut, thus resulting in rejection of H0 because there is insignificant relationship between GDP and NPL.
In conclusion, the overall finding indicates that the second objective of this research has been achieved, which is to investigate the most significant factor that influence non-performing loans. In this study, the result found that interest rate was the most significant factor in affecting NPL and had a positive relationship between them. Inflation rate also has a significant factor with a negative relationship towards NPL. Increasing in non-performing loan will indicate a banking institution were potentially unstable, which will reduce the profitability and liquidity of the bank. Policy implications of this study include on how policy affect dependent variable and action that should be taken to enhance the dependent variables. In order to control the level of non-performing loan in Malaysia's banking institution, Bank Negara Malaysia (BNM) was responsible to ensure the banking system is stable. Therefore, BNM needs to enhance and revise the existing or make new policies on a regular basis. Furthermore, Bank in Malaysia should expand the monitoring framework in order to make sure the borrower pays the loan on time and give some moral support or incentive for those who had a possibility of being unable to pay back the loans.
Lastly is recommendation. Future researchers are encouraged to broaden their research, for example, by using data from numerous banks outside of Malaysia. It can help researchers obtain better and more accurate results by increasing the number of observations. It's also recommended that future researchers employ more variable or any strategy that is more accurate. The inclusion of the other variables would provide the researcher a deeper knowledge of the issue. Furthermore, future researchers can use the other software to analyze and understand the data obtained, such as e-views. Future researchers may obtain data from other sources, such as the World Bank, the IMF data, Econ, and others, in order to improve the precision of the results. Finally, instead of using time series, future researchers can employ panel data, which can provide a clearer and better relationship between the dependent and independent variable.